Today's presentation is on Datadog stock versus Dynatrace stock, and Datadog stock in particular has been brought to our attention by quite a few subscribers, so we wanted to do a little bit of a deep dive into it today. Now, what both these firms have in common is they do something called application performance management, and here's a model by Gartner that describes what that is. And even if you have a background in software engineering, some of this stuff starts to become quite complicated. So when we wrote about this topic before, in this piece you'll see here 5 application performance monitoring stocks. I'll put a link to that piece in the description of this video, but these are best described as software as a service or SaaS firms selling technically complex but very useful services to other companies. And when you evaluate firms like this, you really want to avoid going down the rabbit hole of technical comparisons and stick with just things like stickiness. So once you get this sort of a solution embedded in any company, it becomes relatively difficult to displace. And what another benefit is you'll get channels to IT decision makers. So I remember when I first started my job in financial services, I was interviewed and I asked the gentleman interviewing me what he liked about that company. It was MSCI. And he said, I like the fact that we have channels into every single asset manager, hedge fund, and brokerage firm across the globe. And that advantage proved to be very valuable. MSCI went from a $2 billion company when it IPO'd to $40 billion because they were able to start selling additional things. And that's the value here. When you see them describe these APM firms, they'll describe the total addressable market as some big number like $60 billion, or Splunk says it's $100 billion. These big numbers are based on that presumption that they can start to sell additional things. That's why you'll see them start to acquire other firms and then talk about how many modules their clients are subscribed to. Now, when we look at any particular domain, we want to find the alpha, that is the best stock. Picking the leader is optimal because of things like economies of scale that let them better compete and close out and kill their competitors or acquire them. And when we look for leadership, 2 metrics that we like to use are basically market cap, the size of the company, of course, and their overall revenues. Now, you have to be careful of what we call the proto labs problem, and that's when you invest in a company thinking they're the leader because they dominate in revenues, but they can't grow the firm, and eventually their competitor catches up. Is a great example. You can see it portrayed right here. This is when Proto Labs was nearly, probably already surpassed by Xometry in the distributed manufacturing space. And this is what happens when the alpha male isn't paying attention. And Proto Labs management certainly wouldn't be considered alpha at this point. They swept their aggressive growth targets under the rug and just pretended like nothing happened. And of course, we dumped that stock like a hot potato. Now, the firms that we're going to look at today, out of the 5 APM stocks that we looked at before, 3 stood out in terms of market cap that you see here, but also in terms of what the experts say are the most competitive solutions out there. And one place we like to look for such commentary would be the MBAs over at Gartner. Here's the familiar magic quadrant, and you can see they have Datadog and Dynatrace up in the corner there, the right-hand corner, as leaders, and then you can see New Relic chasing them, and there towards the bottom you see Splunk and Elastic. Now, this has nothing to do with size. It has to do with the perceptions Gartner has of the competency coming from these firms. So what we thought we'd do today is try to come up with some metrics that we could use to compare these 2 firms. What we've described here is SaaS comparison metrics. So just starting from the top, you have annualized revenues and market cap. We talked about those. From those 2 metrics, you can then calculate our simple valuation ratio, and we've written a piece on what that's all about. I'll put a description of that or a link to that in the description of this video. Also, common SaaS metrics are gross retention rate. This would be the percent of your customers not canceling their subscriptions. So it's more or less cancels. Net retention rate. This would be the increased spend from existing customers. You always want to see that above 100%. If it's not, then your existing customers are paying less over time. And the number of customers, this can be very edifying. You have total number. Then you have number over $100,000 a year, where spend starts to become quite meaningful. Again, access to decision makers improves the more money that firms spend with you. And then, of course, the number over $1 million. That shows, when we talk about $100K or $1 million, that's in annual revenues, or run rate, as they call it. Over $1 million, that shows your ability to land large enterprise clients. Then we have last 5 years compound annual growth rate for revenues. That's sort of an arbitrary number. Again, this is a straw man set of metrics, but it's useful nonetheless. We have cash, debt, and average gross margin over the last 4 quarters. That shows their survivability. So if they start cutting back on costs, and they can quickly achieve profitability and stop burning cash. We have geographical diversification as the last one. Now, note that the availability of metrics matters. So some firms we come across don't have sufficient metrics. We wouldn't invest in them, because we need to be able to follow what's going on and describe that not only to ourselves but to our audience. So when you have a black box, how are you supposed to know the health of the firm if you can't describe it using metrics? So we looked at these metrics across 3 firms. Splunk we're holding. That's the relevance of having them on this table. And of course, Datadog and Dynatrace, the 2 firms that this presentation is about. And we just went down the list. So of the largest in terms of revenues, that would be Splunk here. The numbers are in billions for most of the numbers, nearly all the numbers here except customers. So Splunk would win there. Then when you look at market cap, that would be size, Datadog wins, and then down to simple valuation ratio. This is interesting because Datadog is somewhat rich. I think our catalog average is 9, so Dynatrace is around average. Splunk is would be considered undervalued, not only based on a ratio, but just based on commentary from analysts and the private equity firm Silver Lake that they're quite involved with. And moving on down to gross retention rate, this is something most SaaS firms don't provide. Datadog actually provides it, says it's mid to high 90s. Ideally, you want to see that high 90s. Then we have net retention rate, and Splunk describes that 127%. We'll look at that in a second. But then Datadog and Dynatrace, they describe this as 130% plus and 120% plus respectively. That isn't that good, because it doesn't show us trends. And by that, we mean if you look here at this trend that Splunk has, unfortunately, this is only their net retention rate for cloud, which is a component of their business, versus on-premises that they've been growing quite a bit. And you can see that declining over time. And you would expect that. So the larger that you get, the more penetration you have with your clients, the less additional stuff you can sell them. And we see that happening over time here. So it would be great if we had similar metrics for Datadog and Dynatrace. Now moving on to number of customers in total, you can see Datadog has a lot of breadth there. In terms of depth, only one firm tells us the number of customers over 100K. That's 2,600 for Datadog. And there may be some data points that are missing here because they weren't obvious. If you know of those, just pop them in the comments section. We'll plug them in to the article that accompanies this. And then we have number of customers over 1 million. Datadog's number was taken from, I think, the end of 2021. We didn't have a refresh number for that. Splunk's is more recent. Dynatrace doesn't tell us. Notice how Dynatrace doesn't describe their customer base very well. That kind of sucks. Then you move to their the big one for growth investors, which would be their revenue growth, the compound annual growth rate over the last 5 years. You can see Splunk and Dynatrace are somewhat similar, but then look at Datadog, and that's the rich valuation that you see reflects that great growth. Now, whether or not they can sustain that growth in today's bear market, that remains to be seen. Moving on to cash and debt. Holding debt isn't a bad thing. You see Splunk has quite a bit. Debt provides a tax shield. That's something that's quite boring that they make you calculate in B school. But debt isn't necessarily a bad thing, but excessive debt means that you might have trouble servicing it, or there may be covenants attached to the debt that you need to adhere to. And it certainly gives you fewer options to raise capital. And Splunk has taken on a fair amount of debt. Datadog and Dynatrace a lot less. And then we see large cash positions at Splunk and Datadog. That's great. It gives these firms some runway. But all three really have very healthy gross margins of 80% or more, so it's easy for them to pull back on sales and marketing. Although revenue growth will slow, they can get to profitability quite quick. Splunk's last quarter, I believe, was profitable. So that's good. They all seem capable of weathering the bear market. And then the last metric here would be ex-USA revenues, what we call international diversification. And Dynatrace is the best of the three, though these numbers are acceptable. Certainly there isn't any showstoppers here. And the last thing that I wanted to talk about in terms of looking at Splunk versus Datadog, so in case it wasn't obvious on the previous slide, Datadog is superior when it comes to that aggregation of metrics. We would consider them to be the better investment of the three, even though we're already invested in Splunk. But there's one thing being invested in Splunk that we want to consider here. Are we getting ourselves into another proto-lab situation based on that chart we looked at the beginning of this presentation? A couple things to note here. So we've simply plotted Datadog's revenues against Splunk's over time. Of course, as we said earlier, Datadog is growing at 59% and Splunk somewhere around 12%. So we would expect Datadog to be catching up. But look here how fourth quarter for Splunk is always meaningfully higher. That says something about their business model, and that's because Splunk does on-premise and cloud, whilst Datadog has a more smoother cloud software as a service subscription business model. So Splunk's working on that as they blend more cloud into their total offering, but that's one thing to consider. Now, is this a Proto Labs situation where eventually Datadog is going to catch up to Splunk and surpass them in revenues and become the leader? And if we're able to anticipate that, we can switch them out. Well, maybe not so. The first reason is that in the case of Proto Labs, their management team was totally incompetent. So Splunk had switched their CEO out. We wrote about that in a recent piece. By the way, we've covered Splunk quite a bit, and I'll put links to those articles in the description of this video. But what we really like is that a private equity firm called Silver Lake is involved, and they ponied up some of the money for that debt. And if you look at the terms of that debt, they are incented to really increase the share price. In other words, unlock the value that Splunk isn't realizing. We saw earlier they had a low valuation ratio relative to these other two firms. So we're fairly confident that Silver Lake is driving them in the right direction, and we're hoping that this firm can smooth out their revenues and continue their growth. And of course, you have to ask yourself, in the face of today's bear market, is growth going to slow across the board? And if it does, would Datadog merit that high valuation? Well, eventually you would expect growth to resume, and Datadog does have some pretty good breadth in terms of the number of companies using their solution. And when it becomes difficult to get new logos, your growth comes from the net retention rate, getting your existing customers to spend more. So we'll see how that goes. Now, just to conclude, based on the metrics we presented today, we think Datadog's probably the best way to play the APM/SIEM space, or whatever other label might be ascribed to these firms that seems to change every other year. Expect that growth could stall for some or all of these firms in the face of today's bear market. That's when you should be adding shares with confidence, provided your thesis hasn't changed. And it will be tougher to get signatures, so you'd expect to see increasing revenues come from existing customers more so than new logos. And as Mr. Buffett says, it's better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. So I've put up a video here that you might be interested in watching next, but before you watch that, please click the Nanalyze logo on the right here, subscribe to our channel, support us. Thanks so much for taking the time to watch this today.